Welcome to today's deep dive. We actually have an incredibly dense, fascinating stack of materials to get through today.
Yeah, there is a lot to cover.
There really is. And I want to start by asking you to think about something you do constantly, probably without even realizing it.
Right.
Think about the sheer volume of predictions you make before you even have your first cup of coffee in the morning.
Just everyday decisions.
Exactly. You're predicting traffic patterns when you choose your route to the office. You're forecasting macroeconomic trends when you decide whether to lock in a fixed mortgage rate or float a variable one.
We're basically just walking biological prediction engines.
We are. We're constantly calculating probabilities based on imperfect information. And for most of human history, that intuitive calculus just kind of lived and died in our heads.
That was invisible.
But we're looking at a stack of sources today that suggest your everyday intuition, the actual way you assess risk and anticipate the future, is currently being weaponized to completely reshape Wall Street.
It's a massive shift.
And taking it a step further, the way you predict the future is becoming the foundational training data for the next massive leap in artificial intelligence.
Which is just wild to think about.
Yeah.
We are looking at a fundamental rewiring of how risk is quantified and how foresight is monetized.
Yeah.
The transition we're seeing right now, moving from casual speculation to these highly structured, institutional-grade prediction markets, is just unprecedented in its velocity.
Really unprecedented.
If you look at the underlying mechanics of the platforms we are going to discuss today, we're witnessing a structural evolution, one that really mirrors the aggressive institutionalization of digital assets, or even the early days of listed derivatives.
Oh, sure.
We are moving from a frontier novelty to a core pillar of global finance, and the implications for both capital markets and machine learning are just massive.
So to map out this transition, we are pulling from three distinct, highly revealing sources. First, we've got a recent February 2026 market analysis report from Citizens Bank,
Which is an eye-opener.
to say the least. It models out a staggering $10 billion future for these markets. Second, we have a Wall Street Journal breakdown of the current arms race between the two dominant platforms, Kalshi and Polymarket,
Both of which are staring down $20 billion valuation targets right now.
which is just mind-boggling. And third, we actually managed to get access to an internal strategy document for a revolutionary platform called Evumus Predictions.
That's the one that really flips the script.
It really does. This document outlines a completely new paradigm involving no-loss staking and an autonomous AI architecture that fundamentally shifts the goalposts of this entire industry.
Completely.
Okay, let's unpack this. Because whether you are actively trading these markets, managing institutional risk, or just someone who tracks the evolution of AI, the infrastructure of how the world handles human forecasting is being rewritten as we speak.
The Citizens Bank report is really the perfect starting point for us because it strips away all the narrative. It just looks at the raw capital flows.
Right, just the hard numbers.
Exactly. And the numbers they're tracking indicate that this isn't some cyclical trend or a retail fad. We are looking at a permanent structural adoption by entities that need highly specific risk transfer mechanisms.
The velocity of the capital flowing into this space, according to those Citizens Bank analysts, is what really jumps off the page for me.
Oh, absolutely.
They're tracking prediction markets currently operating at over a $3 billion annual revenue run rate. And just to frame that for you, the same analysts had this industry at a $2 billion run rate in December of last year.
So we are talking about a 50% expansion in the revenue run rate in roughly 90 days.
90 days. They flagged a 40% jump in trading volume from December to January alone. And the data point that completely disrupts the mainstream narrative, the one that really stood out to me, is that February maintained that exact same blistering volume pace.
Despite the fact that the NFL season ended.
Exactly. The football season is over.
That February data point is the critical signal in the noise. The prevailing assumption among casual observers has always been that prediction markets are just sports betting wearing a different hat.
Right, just a dressed-up casino.
But when you see volume not just sustain, but actually solidify and grow in a month, completely devoid of a massive sporting catalyst, it proves that the core utility of the platform has shifted.
The liquidity isn't chasing entertainment anymore.
Exactly. It's chasing utility. The Citizens Bank projection modeling a $10 billion revenue landscape by 2030 is predicated entirely on this pivot. Devin Ryan, the lead analyst on this report, makes a very deliberate point of qualifying that $10 billion figure.
Right. He calls it a reasonable medium-term midpoint.
Yes, A reasonable medium-term midpoint. He is aggressively signaling to his institutional clients that $10 billion is not the final ceiling, not even close.
A reasonable medium-term midpoint of $10 billion is just a wild phrase to see in a banking report about an asset class that most of traditional finance was completely ignoring 3 years ago.
It really is.
If the volume isn't coming from sports and the growth is structural, like they say, we need to look at what is actually moving the needle here. The report highlights that the heavy lifting, the massive liquidity pools, are forming around macroeconomic indicators, geopolitical outcomes, and highly specific regulatory decisions.
That's where the real money is flowing.
Right. And right now, if you are listening to this and you manage a portfolio, or if you're an institutional fund manager, you are dealing with an incredibly complex web of localized risks. The Citizens Bank report leans heavily into this concept of basis risk to explain the institutional migration to these platforms. Let's break down the mechanics of that, because this is exactly why Wall Street is suddenly paying attention.
Basis risk is the core problem that prediction markets solve for institutional capital. Let's build out a scenario to illustrate this. Imagine a massive, multi-strategy hedge fund that has a heavy exposure to the tech sector. They are looking at the calendar and they see a highly anticipated, highly contentious Federal Reserve rate decision coming up in 3 weeks. They have internal models suggesting the Fed might deliver a surprise hawkish hike.
Which would severely damage their tech portfolio.
Exactly. So they need to hedge that specific, discrete event. Historically, the tools available to them are incredibly blunt. They might go to the derivative market and short the NASDAQ, or they might buy complex, expensive options on Treasury futures.
But the problem with shorting the NASDAQ to protect against a rate hike is that you're absorbing a massive amount of collateral noise.
So much noise.
You short the index, and maybe the Fed does exactly what you feared, but on the same day, 3 massive tech companies announce record earnings and a new AI breakthrough.
Which happens all the time.
Right. The index rallies anyway, your hedge gets blown out, and you still take the hit on your underlying portfolio. You tried to hedge a single variable, but you exposed yourself to 50 other variables in the process.
And that difference between the specific risk you're trying to mitigate and the actual performance of the instrument you use to hedge it, that friction, that tracking error, that is basis risk.
It's an inaccurate proxy trade.
Precisely. Prediction markets offer a completely different architecture. They allow that hedge fund to bypass the proxy trade entirely. Instead of shorting an index and hoping the correlation holds, the fund can go onto a prediction market and take a direct, highly leveraged position on a contract that explicitly states the Federal Reserve will raise rates by 50 basis points on this specific date.
Yes or no?
Yes or no. It isolates the exact variable. It is a surgical risk transfer mechanism. If the event happens, the contract pays out, perfectly offsetting the portfolio damage with zero exposure to unrelated earnings reports or secondary market noise.
When you understand that dynamic, the explosive growth in these markets makes complete sense. Institutions are just tired of paying for the inefficiency of basis risk.
They really are. And the Citizens Bank report maps out this institutional maturation cycle beautifully. They note that asset classes almost universally follow a predictable sequence. You always start with the retail pioneers who provide the initial chaotic liquidity.
Right, the early adopters.
That raw volume eventually attracts sophisticated automated market makers who step in to harvest the spread and tighten the pricing. And once that pricing becomes efficient and the spreads narrow, the massive institutional whales finally feel comfortable entering the water.
We are sitting right on the fault line of that transition into the whale phase right now. The report details how institutions are already in the ecosystem, but they're currently operating in the infrastructure layer. They aren't necessarily dumping billions into directional trades just yet.
Not yet.
Instead, they are integrating the data. They are piping the real-time, capital-weighted probability signals from these markets directly into their algorithmic trading models. They are acting as liquidity providers to earn yield.
And perhaps most importantly, they are the ones aggressively pushing for standardized clearing and regulatory clarity.
Exactly. They are building the plumbing so that when they are ready to turn on the fire hose of direct trading capital, the pipes don't burst.
The infrastructure build-out is the clearest leading indicator of future volume. When you see major prime brokerages dedicating engineering resources to integrate API feeds from prediction markets, they are not doing it for a novelty project. They are doing it because they anticipate their clients will demand direct execution capabilities very soon.
Here's where it gets really interesting. Because while Wall Street is busy laying down this plumbing, the platforms that actually control this liquidity are engaged in an absolute bare-knuckle brawl for market supremacy.
It is an arms race.
The Wall Street Journal piece we have gives us a look under the hood of this duopoly. We are talking about Kalshi and Polymarket. Both these companies are currently in early-stage talks to raise new funding rounds that would value each platform at $20 billion.
$20 billion.
To put that in perspective, that would double their valuations from late 2025 in a matter of months.
What's fascinating here is that a $20 billion valuation for a prediction market shifts the conversation entirely. At that valuation, private equity and venture capital are no longer betting on a successful startup. They are pricing in the expectation that these platforms will become foundational infrastructure for the global financial system.
They are being priced as the next generation of derivatives exchanges.
Exactly. But what makes this arms race so compelling is that Kalshi and Polymarket are taking fundamentally opposing approaches to market dominance. It is a classic battle of regulatory compliance versus decentralized velocity.
Let's dig into Kalshi first, because their strategy has been incredibly deliberate. Founded in 2018 by Tarek Mansour and Luana Lopes Lara. And they took the hardest possible path.
They really did.
They didn't launch offshore. They didn't launch a token. They went straight into the teeth of the U.S. regulatory apparatus. They spent years grinding through the bureaucracy to become a fully CFTC-regulated U.S. exchange for event contracts.
Playing completely within the traditional financial rulebook.
And the financial metrics the journal is reporting suggest that playing by the rules is paying off massively. They raised $1 billion at an $11 billion valuation last December. And their current annualized recurring revenue, their ARR, is sitting at roughly $1.5 billion.
Generating $1.5 billion in ARR on an entirely new asset class is a staggering achievement. It completely validates their regulatory thesis. By enduring the friction of CFTC compliance, they created a sanitized, legally sound environment.
Which traditional capital absolutely requires.
Exactly. A massive U.S. pension fund or a heavily regulated bank cannot legally interact with an offshore, unregulated smart contract, no matter how good the liquidity is. Kalshi built the bridge for that traditional capital, and you can see it in their open interest.
The numbers are wild.
The journal notes Kalshi is sitting on over $400 million in open interest, meaning $400 million of capital is currently locked in active, unsettled derivative contracts on their books. Furthermore, they are processing $1.87 billion in weekly notional volume.
That is a phenomenal amount of throughput for a regulated entity. But then you look at Polymarket, founded a couple of years later in 2020 by Shane Coplan, and they are playing a completely different game.
Very different.
Polymarket is fully decentralized, running on blockchain architecture. They lean heavily into the Web3 ethos of permissionless access and global liquidity, and they are fighting Kalshi to an absolute standstill.
It's incredible to watch.
Back in October, Polymarket hit a $9 billion valuation, driven largely by the Intercontinental Exchange, the ICE, agreeing to invest up to $2 billion into the platform. Now, let's pause on that ICE investment for a second.
It's a massive detail.
It feels like a massive anomaly. The ICE owns the New York Stock Exchange. They are the ultimate traditional finance incumbent. Why are they pouring $2 billion into a decentralized blockchain prediction market?
It is a profound strategic hedge by the ICE. The Intercontinental Exchange recognizes that the underlying technology of Polymarket smart contracts executing trustless settlement on a global ledger is vastly superior in terms of operational efficiency compared to traditional clearinghouses.
They see the writing on the wall.
Exactly. The ICE isn't just buying equity, they're buying access to the architecture of the future. They know that if decentralized markets eventually capture a significant portion of global derivatives volume, they need to have a massive stake in the winner. And Polymarket's metrics justify that bet.
They do.
They have $360 million in open interest, which is trailing Kalshi slightly, but they are actually pushing slightly more volume, hitting $1.9 billion in weekly notional throughput.
It is a pure dead heat. You have the regulated U.S. entity and the decentralized Web3 entity both turning nearly $2 billion a week, both hunting for that $20 billion crown.
It's fascinating.
But what fascinates me about the journal's data is the complete lack of a middle class in this industry. Usually, in a massive tech or finance boom, you have a strong number one and two, but then you have a scrappy number three, a solid number four, and a bunch of regional players. That is not the landscape here at all. The drop off after Polymarket is absolutely a cliff.
The network effects in prediction markets are incredibly brutal. Liquidity is a supermassive black hole. It consumes everything around it. Traders demand tight spreads and immediate execution, which you only get in the deepest pools.
Right.
The third player mentioned in the data, Opinion, is a perfect case study in how punishing this market is. Opinion has a meager $36 million in open interest.
Compared to 360 million or 400 million for the big two.
Exactly. But the real story is their volume collapse. The sources indicate their weekly volume was hovering around $1.2 billion, and then immediately following their token launch, it cratered to $150 million.
That token launch detail is incredibly telling. A drop from 1.2 billion to 150 million overnight means that the initial volume was almost entirely mercenary.
It wasn't organic demand for their markets. It was airdrop farmers.
Right. Users were wash trading and artificially inflating volumes strictly to qualify for the platform's token generation event. The second the token dropped and the financial incentive to fake the volume disappeared, the users vanished.
Revealing the actual underlying demand.
Which was virtually non-existent compared to the big two. It proves how hard it is to build sticky liquidity. And the success of Kalshi and Polymarket in building that sticky liquidity has effectively set off air raid sirens across traditional finance.
The incumbents realize their lunch is on the table.
They really do. The journal highlights that massive retail pipelines like Coinbase and Robinhood are aggressively moving to integrate these specific prediction markets directly into their consumer apps. But the real shocker is that the foundational giants of traditional derivatives, Nasdaq and Cboe, are quietly exploring their own versions of yes or no binary bets tied to traditional market directions.
What's fascinating here is that it's the innovator's dilemma playing out in real time. Nasdaq and Cboe make their billions on complex options and futures contracts, but they are looking at the exact data we just discussed.
They see the shift.
They see institutional clients realizing that a direct binary event contract is a far more efficient hedge than a complex option strategy. If a fund manager can get a cleaner hedge on Polymarket with lower basis risk, they will stop trading Cboe's volatility index products.
Right.
So the incumbents are forced to cannibalize their own complex product lines and launch simplified binary bets just to defend their market share against the upstarts.
They are scrambling to adapt. But as massive as this $20 billion battle is, and as disruptive as it is to see the Nasdaq pivoting to binary bets, everything we have covered so far is still operating on a legacy paradigm.
Yes, it is.
Because whether you were on Kalshi, Polymarket, or the Cboe, the fundamental physics of the transaction remain exactly the same. You put your principal capital at risk, and if your prediction is wrong, your capital is destroyed. It is a zero-sum mechanic.
Someone wins, someone loses.
Exactly. And that brings us to the third piece of source material today, the internal strategy document for Evumus predictions. Evumus is looking at everything Kalshi and Polymarket are doing, looking at the billions of dollars flowing through those systems, and their thesis is essentially that the entire industry is structurally flawed.
Flawed because it relies on the threat of financial ruin.
Right.
Evumus is attempting to orchestrate an evolutionary leap in market design. To grasp their strategy, we really have to isolate the single greatest friction point in financial participation. For you, the listener right now, if you are incredibly confident about a macroeconomic trend, let's say you are certain about the outcome of an upcoming election or a major Supreme Court ruling, what is the primary reason you don't go onto a platform and wager $1,000 on it?
It's loss aversion, plain and simple. Even if I am 90% sure I'm right, that 10% chance of being wrong and watching $1,000 evaporate from my net worth is paralyzing.
Exactly. The psychological pain of losing capital is statistically far stronger than the pleasure of gaining it.
It's the reason the vast majority of people will never trade futures or options. The anxiety is just too high.
Evumus identified that loss aversion isn't just a user preference. It is a hard cap on their total addressable market. Their solution is a mechanic they call no-loss wagering.
I want to spend a lot of time breaking this down because when I first read the documentation, I assumed it was a gimmick. But the tokenomics underlying it are incredibly sophisticated. On Evumus, you do not buy contracts with cash or stablecoins. You participate by staking the platform's native token, the EVMS token. Now, for the listener who might be familiar with Web3, staking is common. You lock your tokens into a smart contract. You can't sell them, but you still own them. Evumus uses this staking mechanic as collateral for your prediction.
It separates ownership from liquidity. When you stake your EVOS tokens on a prediction window, say, predicting that a specific tech company will launch a revolutionary product by Q3, you are not spending those tokens. You are simply locking them up for the duration of the event.
Let's trace the decision tree here. If your prediction is correct, the document outlines a multi-tiered reward structure. You capture the upside. You might earn a percentage of the total volume generated in that market, paid out in additional EVMS tokens.
Or you might receive minor upgrades, giving you more governance power or better yields within the ecosystem.
Or you might receive a reduction in the lockup time for your currently staked tokens, giving you faster access to your liquidity. You get rewarded for accuracy.
That is the standard Web3 incentive model. But the innovation is what happens on the other side of the tree.
The losing side.
Right. If your prediction is completely wrong, you do not lose a single EVMS token. Your principal balance remains exactly the same as it was before you made the prediction. The smart contract does not seize your assets. Instead, it simply extends the lockup period for those specific staked tokens.
The penalty is time, not capital.
Exactly.
If I stake 1,000 tokens and I'm right, I get a bonus. If I stake 1,000 tokens and I'm wrong, I still own 1,000 tokens. I just can't unstake them or sell them for another 3 months or 6 months, depending on the severity of the penalty. They have fundamentally rewired the risk calculus.
The psychological implication of penalizing with time rather than capital cannot be overstated. It completely removes the anxiety of financial ruin. A user can make a highly speculative, contrarian prediction, knowing that the worst-case scenario is simply delayed access to their assets.
It frees them up to participate.
Yes. But the true elegance of this design isn't just in the user acquisition strategy. It's in the macroeconomic feedback loop it creates for the token itself.
Let's dive deep into that macroeconomic loop. When I read this part of the strategy document, I kept trying to find the flaw. If nobody loses their tokens, how does the economy not just inflate into oblivion? How does the token maintain any value if the protocol isn't burning the loser's capital?
It comes down to the mechanics of a token sink. Let's look at the statistical reality of forecasting complex events. The vast majority of predictions will be wrong.
People are terrible at predicting the future.
They are. So when you have a global user base making thousands of predictions a day, and the majority of them are incorrect, you have millions upon millions of EVMS tokens automatically having their lockup periods extended.
I see.
Users are voluntarily sequestering their own assets. If a user gets a 6-month penalty and then makes another bad prediction out of frustration, that penalty might extend to 9 months or a year.
Yeah.
This creates a massive, continuously growing pool of illiquid tokens.
Which chokes the supply.
Precisely. By drastically reducing the circulating supply on the open market, the protocol naturally throttles sell pressure. If a massive percentage of the token supply is locked in time penalties, those tokens cannot be dumped on an exchange.
So human fallibility becomes the primary stabilizing force of the platform's monetary policy. The more wrong people are, the more scarce the circulating token becomes. It is an auto-balancing economy.
It's brilliant tokenomics.
And the document highlights a secondary psychological trap here, a highly retentive engagement loop. Because if I have accumulated a massive time penalty on my tokens because of a string of bad predictions, I don't just abandon the platform. I am highly motivated to keep participating.
Because you want your liquidity back.
Right. The only way I can actively reduce that accrued penalty and get my tokens liquid again is to make correct predictions. I am incentivized to stay on the platform, research harder, analyze the data more deeply, and improve my forecasting accuracy just to dig myself out of the time debt.
It creates an incredibly sticky user base that is heavily incentivized to produce high-quality predictions. And that brings us to the critical inflection point of this entire deep dive.
The real motive.
Everything we have discussed about Evumus, the no-loss staking, the time penalties, the brilliant tokenomics, the gamified user retention, all of it is a facade.
Which blew my mind.
It is a beautifully engineered mechanism, but it is not the actual product.
This is where the document takes a hard left turn into sci-fi territory. I'm going to read a direct quote from the internal strategy section because it completely recontextualizes everything we just talked about. The document states, Evumus Predictions is fundamentally not a betting platform or casino.
Think about the implications of that sentence.
Right. In a casino, or on a traditional platform like Kalshi, the business model is taking a cut of the capital that changes hands. The house wants volume because the house takes a fee, and ultimately the house wins when the user loses.
But Evumus isn't taking your principal when you lose.
Exactly. So if they aren't extracting your capital, what is the actual commercial value of this massive global infrastructure?
The commercial value is the data. Evumus is not building a financial exchange. They're building a globally distributed, financially incentivized data harvesting engine. The true motive is to generate high-fidelity human behavioral data to train advanced, domain-specific artificial intelligence models.
They are farming human intuition.
Exactly. When you want to build a truly predictive AI, you cannot just feed it historical data tables. Historical data only tells the AI what happened. It doesn't teach the AI how to anticipate what will happen next. To teach an AI to reason about the unknown, you need to map the architecture of human intuition.
They are crowdsourcing the human subconscious. They want to quantify the invisible math we do in our heads. When a user is researching a market, considering the odds, and finally deciding to stake their tokens, they're leaving a digital footprint of their cognitive process.
And the strategy document details the variables they are capturing. The AI is tracking exactly when you enter a prediction window relative to the news cycle. It tracks the size of your stake relative to your total portfolio, which indicates your conviction level.
It tracks how quickly you change your prediction when new information breaks.
Yes, it measures your contrarian tendencies. Do you follow the crowd consensus, or do you stake against it?
By capturing those granular behavioral variables across millions of users and mapping them against the actual resolved outcomes of those events, Evumus is building the most robust data set of human forecasting ever created.
They are training the AI to recognize the subtle, intuitive signals that humans use to accurately predict the future, signals that traditional algorithms completely miss.
But this introduces a massive architectural problem. We're talking about a decentralized Web3 environment where users are highly incentivized to get the right answer to avoid time penalties. How do you prevent systemic manipulation?
That is the Achilles heel of Web3 markets.
Right. If the users are empowered to create their own markets, what stops me from creating a market that says, will I wear a blue shirt on stream today? I stake all my tokens, I put on a blue shirt, the market resolves, and I take the rewards. If the data is polluted with manipulated subjective garbage, the AI training model is completely worthless.
The problem of oracle manipulation and subjective resolution is the graveyard of decentralized prediction markets. An oracle, in this context, is simply the mechanism that takes real-world data like the final score of a game or the result of an election and feeds it onto the blockchain to settle the contract. If humans control the oracle, humans will eventually corrupt the oracle.
So how does Evumus handle it?
Evumus attempts to solve this by entirely excising the human element from the creation, management, and resolution of the markets. They rely on deep AI integration at every single step. Let's examine the life cycle of an Evumus market to see how this autonomous governance works.
Okay, walk me through it.
It begins at the prompt creation phase. When a user attempts to launch a new prediction window, the Evumus AI intercepts the prompt and evaluates it in real time using advanced natural language processing. It is scanning for three specific criteria: objectivity, verifiability, and independence.
And the strategy document gives a very clear dichotomy on this.
It does. If a user submits, "Will Spain win the 2026 World Cup?" the AI instantly approves it. The event is binary, it is globally verifiable through thousands of independent data sources, and most importantly, the user creating the market has absolutely no ability to influence the outcome.
But if the user submits the blue shirt example, or as the document specifically notes, will I say hello 3 times on my Twitch stream, the AI instantly rejects the prompt. It parses the context and recognizes that the creator holds unilateral control over the resolution. It identifies the manipulation vector and shuts it down before it even reaches the platform.
That real-time semantic validation is impressive. But what happens when you have a market that is objective and verifiable, but theoretically manipulatable if someone has enough money?
Let's say someone creates a market for a highly obscure minor regional election or a very low-tier esports tournament. The outcome is objective, but a bad actor could theoretically bribe a player or heavily fund a local smear campaign to force the outcome and win the digital prediction.
That is where the AI's dynamic risk management layer engages. The AI doesn't just evaluate the semantics of the prompt, it calculates the real-world economic context of the event. The AI assesses the manipulation cost. How much capital would it realistically take to successfully bribe that esports team or alter that local election?
It sets a baseline.
Once it establishes that baseline, it constantly monitors the total value of EVMS tokens being staked on that specific market. If the digital value staked on the platform begins to approach or exceed the real-world cost of manipulating the event, it triggers a circuit breaker.
The AI recognizes that a perverse incentive has been created.
Exactly. It is now mathematically profitable to cheat in the real world to secure the payout in the digital world.
So it autonomously enforces volume caps. It will literally freeze the market and prevent any further tokens from being staked to ensure that the financial incentive to maintain integrity always outweighs the incentive to manipulate. That is incredibly elegant.
It is. And then you have the final boss of decentralized markets,
Yeah.
resolution. When the event is over, who actually pushes the button to say yes or no? I've seen massive liquidity pools on other platforms locked up in endless disputes because the wording of a market was slightly ambiguous and a council of human arbiters had to vote on the outcome.
Leading to accusations of bias and insider trading.
Constantly. Evumus eliminates the arbitration council entirely. At the exact moment the market is initially created and approved by the AI, the system permanently locks in the official, specific data sources that will be required for verification. It establishes the ground truth before a single token is staked.
So there's no debate later.
None. When the timeline of the event triggers, say, midnight on election day, the AI autonomously scrapes those predetermined data sources. It uses its natural language processing to validate the outcome across multiple feeds, achieves consensus, and then executes the smart contract resolution instantly.
There is no human intervention, no voting period, and no room for subjective interpretation. It is a completely closed-loop, trustless execution.
It secures the integrity of the data, which, as we established, is the entire point of the platform.
So we have this massive AI-governed autonomous data harvesting engine running on a no-loss tokenomic model. How does this translate to the actual user interface? What does this mean for you, the person logging in every day?
This leads us to the final section of the strategy document, which outlines a completely radical approach to the creator economy. They are taking the tools of financial market creation and democratizing them.
Right, because on a traditional exchange like Kalshi or even Polymarket, the platform developers largely dictate the available markets. They decide what is important enough to trade.
Evumus inverts that hierarchy completely. They are empowering the community to act as market creators. This is a crucial pivot. You are no longer restricted to forecasting the Super Bowl or the presidential election.
So what does this all mean?
It means if you are deeply embedded in a highly specific niche, say you are an expert in experimental biotech trials, or you run a massive community dedicated to a specific speedrunning video game show, you can leverage the Evumus AI to create a custom prediction window tailored entirely to your community.
You can tokenize the cultural moments of your specific niche.
Exactly. And the document discusses this, leading to viral market creation. They introduce a concept called remixing.
Which sounds like something straight out of TikTok, but applied to derivative contracts.
That's exactly what it is. If you see a user create a brilliantly structured prediction window, maybe a highly engaging multi-stage format for predicting the box office returns of summer blockbusters, you don't have to reinvent the wheel. You can clone their market structure, remix the parameters for a different industry, and launch it to your own audience.
And this remix culture is fueled by a deep financial incentive. Market creators are not doing this for exposure, they're doing it for yield. The creator of a market earns a percentage of the total volume generated within their specific prediction window.
They earn ecosystem rewards based on the depth of engagement they drive.
This completely changes the user acquisition model. Evumus doesn't need to spend tens of millions of dollars on traditional marketing campaigns. They are heavily incentivizing influencers, content creators, and community leaders to actively evangelize the platform. A creator will push their custom market to their massive audience because their own yield is directly tied to the liquidity they can generate. It is a self-sustaining viral growth loop.
It turns every influencer into a proprietary exchange operator. But while empowering Twitch streamers and credit communities is great for initial velocity, what really elevates Evumus into a potential mainstream juggernaut is how they are leveraging the no-loss mechanic to solve a massive problem for Fortune 500 corporate partnerships.
The strategy document lays out a value proposition for major brands that is genuinely disruptive. It all hinges on regulatory safety and brand association, because the Evumus mechanic ensures that the user's principal capital is never at risk of loss. It is strictly, legally classified as not gambling.
It provides what the internal document refers to as a completely brand-safe environment.
Which is huge.
Brand safety is the ultimate bottleneck for mainstream corporate adoption of Web3 or prediction platforms. A massive family-friendly corporation, let's say a major global beverage company, or a legacy automotive brand, simply cannot sponsor a traditional prediction market.
The PR nightmare and the regulatory scrutiny of being associated with a platform where users can lose their life savings on a bad bet is an insurmountable barrier.
But Evumus bypasses that entirely. Because nobody loses their capital, a major brand can safely sponsor a gamified forecasting window without any of the toxic stigma associated with gambling.
The document provides a phenomenal hypothetical example to illustrate this. They outline a scenario where a global brand, like Nike, sponsors a massive prediction window for the NBA Finals. In a standard Evumus market, if you win your prediction, you get token bonuses or reduced time penalties. But in a corporately sponsored window, the yield for a correct prediction isn't digital tokens. It is tangible, real-world products.
Real-world yield.
Right. The prompt would look something like this. Stake your EVMS tokens on the outcome of the NBA Finals. The most accurate forecasters will receive exclusive, limited edition Nike sneakers. When I read that, it hit me that this isn't just a new feature for a crypto platform. This is a complete paradigm shift for the digital advertising industry.
It is the evolution of digital marketing, from passive extraction to active engagement. Think about the legacy advertising model that brands currently spend billions on. They are paying for a CPM model, cost per mil, or cost per 1,000 impressions. A user is scrolling through a social feed, they glaze over a banner ad, or they aggressively click skip on a pre-roll video.
The engagement is entirely superficial. The user resents the ad for interrupting their experience.
Now, contrast that passive friction with the architecture of a sponsored Evumus market. To win those highly coveted exclusive sneakers, the user cannot just click a button. They have to lock up their own assets. They have skin in the game.
Because their assets are staked, they're going to spend hours, perhaps days, deeply researching the matchups, analyzing player statistics, engaging in community debates, and carefully considering various outcomes before they finalize their prediction.
They are actively, voluntarily immersing themselves in the event. And, by direct extension, they are immersing themselves in the sponsor's brand ecosystem.
They are dedicating intense cognitive cycles to the process. They aren't staring at an ad. They are intellectually invested in the outcome the brand is sponsoring. It is the difference between shallow impressions and deep, prolonged engagement.
And it perfectly aligns the incentives of all four parties involved. The user gets the intellectual thrill of forecasting and the opportunity to earn real-world, high-value yield without risking their capital. The community creator gets a powerful monetization engine. The corporate brand gets unprecedented, positive, deep engagement without the regulatory risk of gambling.
And Evumus gets the holy grail.
Evumus gets the behavioral data.
Yeah.
By bringing in massive brands to sponsor cultural events, they dramatically widen their demographic net. They aren't just harvesting the intuition data of niche crypto traders anymore. They are capturing the cognitive footprints of millions of mainstream sports fans, pop culture enthusiasts, and everyday consumers deeply engaged in predicting complex outcomes.
It is a brilliant, multifaceted synthesis of Web3 tokenomics, corporate marketing, and autonomous AI development.
It really is.
It is a lot to process. Let's take a breath and zoom out to look at the massive journey we've just taken through these sources. We started with the raw, explosive numbers from the Citizens Bank report, establishing that prediction markets are rapidly crystallizing into a $10 billion institutional asset class. We explored the mechanics of basis risk and why Wall Street needs these surgical instruments to hedge discrete events.
We look at the Wall Street Journal data, watching the duopoly of Kalshi and Polymarket race toward $20 billion valuations, proving that both regulated compliance and decentralized velocity have massive, multi-billion-dollar product-market fit.
While traditional giants scramble to avoid obsolescence. And finally, we dissected the Evumus strategy document, uncovering a platform that fundamentally rejects the zero-sum nature of finance. By implementing no-loss staking and time penalties, they eliminate the friction of loss aversion.
And beneath that gamified creator economy lies the true engine, an autonomous, AI-governed system designed to harvest the world's most robust dataset of human intuition.
It is a perfect storm of behavioral psychology, decentralized finance, and machine learning.
It is a remarkable convergence of technologies. And as we synthesize all of this data, it leads to a profound, almost philosophical implication that isn't directly stated in any of these reports, but is the inevitable destination of this trajectory.
Let's hear it.
If platforms like Evumus are truly successful in their ultimate mission, If they manage to build an advanced AI that is perfectly trained on billions of granular data points of human behavioral forecasting, an AI that deeply understands how to aggregate human intuition at a global scale, at what point does the prediction market stop simply predicting the future and start actively creating it?
That is a fascinating shift in perspective. You are talking about the observer effect applied to global events.
Exactly. Consider the implications. If we eventually develop a flawless AI oracle, an intelligence trained so perfectly on our collective intuition that it can output the exact probability of tomorrow's events with mathematical certainty. What happens when that prediction is published? Does simply knowing the perfect prediction alter the variables? Does the existence of an infallible oracle fundamentally change how human beings will act tomorrow, thereby altering the very future the oracle is attempting to predict?
A self-fulfilling prophecy, powered by machine learning and fueled by the crowdsourced intuition of millions of people trying to win limited edition sneakers.
Exactly.
It is a staggering concept to wrap your head around, and it completely redefines what it means to anticipate the future. And that is exactly the kind of provocative, edge-of-the-map thought we love to leave you with. We have covered an immense amount of ground today, from the plumbing of Wall Street derivatives to the psychological mechanics of AI training data. We want to thank you so much for joining us on this deep dive. Keep questioning the data around you, keep trusting and analyzing your own intuition, and we will see you next time.